Hi everyone, welcome back. For anyone that wasn't here for this morning's session, I'm Carol Comerton-Ford. I'm an academic advisor with Plato, and welcome to the conference. For those that didn't join this morning, just a quick rundown on how the sessions are structured. So we'll have two papers presented this afternoon. Each paper has about an hour, so that will involve 30 minutes presentation from the author. Feel free to send through questions on the chat during that presentation if there's anything that needs clarification. We'll take a short break halfway through to answer any of those questions if any arise. And then after the presentation, we'll go to a discussant who will give you some perspectives on the paper and the policy implications and any other issues that arise from the paper. And then we'll have an opportunity for some Q&A from you. Again, that's restricted to doing so via the web chat. So I encourage you to send through any questions that you might have. You can find the area to post questions on the left-hand side of your screen. If you click on the details box, it will take you to another screen where you can select questions and then send your questions through, and I'll relay those to the presenters. So the first paper we have today, or this afternoon rather, is a paper titled Stock-Specific Price Discovery from ETFs. It's written by Thomas Ernst. Tom recently completed his PhD at MIT and has recently joined the faculty at the University of Maryland as an assistant professor. So over to you, Tom.
All right, thank you, Carol. All right, so I'm going to be looking at the question of how ETFs are changing price discovery. An ETF is just a basket of stocks. There's a lot of interesting features about ETFs. The one I'm going to be focusing on today are how there's an active secondary market for ETFs and how this is changing price discovery. So when you take these stocks and bundle them in a basket, you can directly trade these ETF shares. And this direct trading of ETFs has become extremely popular. Around 30% of exchange trading comes from trading in ETF shares in the US. Now, this extreme popularity of ETFs has raised some concerns. So the first concern is that ETFs are replacing stocks. Bank of America reports that over a 10-year period, their clients bought a net $160 billion worth of ETFs while selling $200 billion worth of single stocks. Suggests that they're selling out of stocks and only trading ETFs from now on. The Bank of International Settlements Quarterly summarizes the concern over this switch, which is that ETF investors have scant interest in the idiosyncratic attributes of individual securities in an index. They do not devote resources to seeking out and using security-specific information. Hence, an increase in the share of passive portfolios might reduce the amount of information embedded in prices and contribute to pricing inefficiency and misallocation of capital. My paper, with model and evidence, is going to show how ETFs can actually contribute to stock-specific price discovery. How are they going to do that? Well, it's going to depend on stock-specific characteristics. For traders in large or medium stocks, I'm going to show that these traders can access ETF liquidity. The model shows that if noise traders switch to trading ETFs, informed traders follow them. They trade both the stock and the ETF. I'm going to present empirical evidence that they do just that. They trade the stock and ETF in tandem. I'm going to show you from microsecond TAC data that investors place same direction simultaneous trades in the stock and the ETF. These tandem trades are driven by stock-specific information. These trades are profitable, earning negative realized spreads, and they're sizable, making up 1 to 2% of total ETF trading volume. And that means for larger medium stocks, ETFs are going to have a limited impact because informed traders can respond by trading the ETF. And that means our concerns about ETFs are going to be localized to small stocks. In the model, investors don't trade ETFs. They face too much adverse selection when they're only informed about a small piece of the ETF. And empirically, I do not see evidence of these tandem trades in small stocks. Before I move on, I want to take a second to place these results in the broader literature. ETFs go back to the first index fund work, like Gorton Pinocchi. There's more recent ETF-specific papers, and it also relates to the derivatives literature, and that ETF is a redundant security. Now, in my paper, ETF investors are going to strategically trade a stock and ETF in tandem. And this means that this tandem trade is only going to be justified in the model for large or volatile stocks. So the ETF is going to have a different effect on large stocks than the effect on small stocks. Empirically, my paper is going to use trade-level data to analyze this tandem stock ETF trading relationship. And that'll allow me to analyze how this stock ETF relationship varies with stock-specific characteristics. So for my talk today, I'm going to do three things. I'll first give a simple practical example of the model ideas, how investors place these tandem trades only for larger or volatile stocks. Second, I'll describe the empirical identification strategy where I document these simultaneous, same direction stock ETF trades. And third, I'll highlight my key results. These tandem stock ETF trades are profitable, driven by stock-specific information, and a sizable share of ETF trading volume. So, to the very first question, when do traders trade both the stock and the ETF? Well, most of the liquid ETFs are value weighted. So I have up here the holdings of XLK, the technology sector spider. As you can see, Microsoft makes up 20% of the ETF. When you're trading a share of XLK, you're trading 20% of the value of what you're trading is a claim on Microsoft stock held by the ETF trust. So if you imagine that you're an investor and you have an informational advantage about Microsoft, you can't help but find yourself with an informational advantage about this technology sector spider. If you don't trade XLK, you're effectively leaving money on the table. You could maximize your trading profits by trading both Microsoft and the technology sector spider. Now, the next stock I want to highlight is PayPal. And PayPal is only 2% of the technology sector, which might seem small. But here we have to remember that volatility is time varying. So if we imagine a day when PayPal has very serious news, the volatility of PayPal could jump to 5 or 10 times the volatility of the other stocks in this sector. And that means the share of the technology sector price movements explained by PayPal will accordingly rise. PayPal could start explaining as much as Microsoft in how the technology sector moves. Even though it's small, it can move a lot to move the overall index. And final stock I want to highlight is Xerox. Xerox is such a small part, not 0.1%, that even if Xerox is volatile, it's not going to cause big movements in XLK. And if you're an investor in Xerox and you try to trade XLK, you would come up against investors who are much better informed, who know about stocks like PayPal or Microsoft, and so it's just not something that you'd be able to do. So the key insights from the model, that investors with stock-specific information are going to trade stocks and ETFs in tandem. Tandem trading offers more liquidity than trading the stock alone, but it requires a sufficient weight or informational asymmetry. Now, traders in large or medium stocks can access this ETF liquidity. If we think about stocks like Microsoft or PayPal on a volatile day, and that means the potential harms of ETFs are limited. If the liquidity moves, informed traders can follow it. That means our concerns about ETFs are going to be localized to small stocks, stocks like Xerox, where investors face adverse selection in the ETF. Okay, so now I've given a practical example of model ideas. So the second thing I'm going to do is describe my empirical identification strategy, how I document these simultaneous same direction stock ETF trades. So I want to show that investors trade stocks and ETFs in tandem. And to do that, I'm going to use New York Stock Exchange Trade and Quote data, TAC. This data is anonymous. You might be wondering, how from anonymous data could I show that investors are trading two different assets? Well, TAC has two advantages. First, it's extremely detailed. It contains every trade and quote, almost 30 gigabytes per day of data, and it's extremely high resolution. Trades are timestamped to the microsecond, starting in August 2015. So what I'm going to do is, well, if investors trade multiple securities, I could tell that from TAC data, anonymous TAC data, if they traded both securities simultaneously. Now, why would they trade both securities simultaneously? Well, this borrows from a common idea in Michael Lewis's book, The Flash Boys, a bestseller in 2014. The idea in this book is if investors want to buy a stock, they should buy from every market center simultaneously. If you want to trade at NASDAQ, you should also get any shares at the New York Stock Exchange. That prevents someone from front-running to the other exchange and buying the shares before you get a chance. So you should time your trades to arrive at both market centers simultaneously. I'm going to do a multi-asset version of this. If investors want to buy both the stock and the ETF, buying both at once prevents front-running of the trade. Now, for this to work, there are three things I need to do. I need to first rule out that these trades are responding to each other. I need to second rule out that these trades are due to chance. I'm going to third need to rule out that these trades are an alternative story like hedging or arbitrage. So for the first point, can I rule out that these simultaneous trades are somehow responding to each other? It comes down to how fast a trader could respond to an order. Now for my empirical work, I use a set of high-performance computing servers. And between these servers, it takes about 150 microseconds to send a node from one node to the other. Now, exchanges are going to have much lower latency than research clusters, but there's going to be a limit to how much lower the latency can get. So I have here a very simple diagram of a stock exchange. Trades take place at the limit order book, and all traders, any trade that happens at the limit order, must get there by passing through the gateway. And this trip from the gateway to the limit order book and back takes time. Across all the different exchanges, it takes at least 20 microseconds. So if I see two trades that are less than 20 microseconds apart, I can rule out that one of these trades is responding to the other. So that takes me to the second point. Can I rule out that these trades are somehow due to chance? I have here a trade timestamp. So let's say this was a Microsoft trade at 10:32 a.m. And for this very narrow window, plus or minus 20 microseconds, I'm going to check for a simultaneous trade in the ETF. Now, to rule out that I'm somehow picking up chance trades, I'm going to also estimate a baseline level of trades that happen close, but not exactly at the same time. That'll be trades plus or minus 1,000 to 2,000 microseconds. And what you'll see in a second is that there's a very clear, stark difference between these two regions. What I've plotted here is cross-market activity for a single day between Microsoft and XLK, the technology sector spider. What I'm showing at 0 is the total number of times per day that the stock and the ETF traded at exactly the same microsecond. At negative 1,000, I'm showing how many times the ETF traded exactly 1,000 microseconds before the stock. And at a positive 1,000, I'm showing how many times the stock traded exactly 1,000 microseconds before the ETF. Now, simultaneous trades are going to be this very narrow, very clear spark right around 0. And then out here, when you see this baseline, there's almost nothing. And so there's this very clear non-random pattern that there's this simultaneous trading of investors with the stock and the ETF. That takes me to the third point, which is, what if these simultaneous trades are something like hedging or arbitrage? So to rule out this story, I can sign trades as buy orders or sell orders. So if you see a trade at the best bid, that's going to be a sell order. And the trade at the best ask is going to be a buy order. And if I sign these trades, they're overwhelmingly of the same sign. So I have a plot here of these trades, and along the x-axis, I'm showing what's the chance, if the stock is a buy order, that that simultaneous ETF trade is also a buy order. You can see simultaneous trades are very close to 100%, buys with buys. The same thing is true on the y-axis with sells. If the stock order is a sell, the ETF is overwhelmingly likely to be a sell order. So investors are either buying the stock and buying the ETF, or selling the stock and selling the ETF. That's inconsistent with hedging or ETF arbitrage. So with that, I have this measure of simultaneous same direction stock ETF trades. And now I'm going to move into the third section, where I'm going to show that these tandem trades are profitable and a sizable share of ETF trading volume. They're driven by stock-specific information, and I'll cover some extensions of the results. With that, I'll check in with Carol if there are any questions.
No, we've not got any questions yet, so
okay,
keep going.
Sounds good. I'll keep on. Okay, so simultaneous stock ETF trades. The first question is, do these simultaneous trades appear informed? And the answer is yes. On average, these trades are negative realized spreads. If I compare the trade price with the mid quote in the security 5 minutes after the trade, investors earn about 1 penny on the stock side of the trade and half a penny on the ETF side of the trade. And the second question is, are these simultaneous trades sizable? The answer again is yes. These simultaneous trades are a sizable share of trading volume. Around 1 to 2% of ETF trading volume comes from these simultaneous stock ETF trades. If we think about some estimates of the level of overall informed trading as around maybe 10% of trades, 1 to 2% is a pretty serious fraction of that informed volume. So now I have to show you that stock-specific information drives these tandem trades. So in the model, a large informational asymmetry and a large ETF weight cause investors to have a profitable opportunity to place a simultaneous stock ETF trade. I'm going to look at 3 different measures of stock-specific information: earnings dates, intraday return, and news articles and press releases aggregated by Ravenback. For all of these measures, I'm going to test how simultaneous stock ETF trading varies with these information measures. To do that, I'm going to use a sample of SPDR and the 10 sector SPDR ETFs, along with their 500 underlying stocks. I'm going to use microsecond TAC data from August 25th to the end of December 2018. Now, for each stock and ETF, I'm going to run the following regression. I'm going to look at how simultaneous trades on that date vary with the weight, the information measure, and an interaction term between that weight and information measure. And crucially, I'll also confirm a control for the ETF with a fixed effect and an ETF weight return interaction. Now, my theory predicts that alpha 3 should be positive. When there's a large ETF weight and a large informational asymmetry, that's when investors should trade both the ETF and the stock. What I have here on this is that regression for the earnings dates and absolute return. You can see that these coefficients are positive and statistically significant. For a large stock like ExxonMobil, on a typical day, there's going to be 800 stock ETF simultaneous trades. On earnings dates, we'll see a 15% increase in the simultaneous trading activity. On days with a 1 or 2% absolute return in ExxonMobil, we'll see a 50 to 100% increase in simultaneous trading. Those simultaneous trading level will double. And those increases hold controlling for effects like the ETF return. So it's something stock-specific driving these results. To really drill down on that, I have a second measure, which is intraday news events from Ravenpack. There are 136,000 unique news events in my sample period, and Ravenpack tags them to specific stocks. So we can suppose that Microsoft has a news story. I know then that informational asymmetries in Microsoft should be larger around the timing of that news event compared to other stocks in the sector. And so what I can do is I can take a 5 or 30-minute window around that stock-specific story and look for simultaneous trades. And I can compare that to every other stock in the sector. What I want to see is that when Microsoft has a story, there's a spike in Microsoft technology sector simultaneous trades that doesn't show up in a stock like Apple or PayPal, other technology sector stocks. And I see just that pattern. There are more stock ETF simultaneous trades for the stock with the news event, and larger weight stocks see even more of these simultaneous trades. So I've shown you that simultaneous trades are a profitable and sizable share of ETF volume, and that these stock-specific information drives these simultaneous trades. With measures like earnings dates, intraday return, news articles, and press release, all of these lead to more of these simultaneous stock ETF trades. So now I'm going to highlight 2 extensions, simultaneous trades between different ETFs and stock ETF triple trades. So if you think about the sector SPDR, those sector SPDRs together comprise SPY. Now, tandem trading, this tandem trading strategy really makes sense for any 2 sufficiently correlated assets. If you know about one asset and there's this other correlated asset, it makes sense to trade both those assets. So one natural case where we could think about this is if you want to trade a given sector of the ETF, well, if it's a large sector in the S&P 500, then that sector SPDR, you could trade that sector SPDR as well as the S&P 500. And so if you have information about the technology sector and you think the technology sector will do well, since it's 25% of the index, you also think the S&P 500 will do well. And I see the same pattern of simultaneous trading activity. When a sector has a large return, I see more of the simultaneous sector and S&P 500 index simultaneous trades. And the effect is even stronger for larger sectors. And so this takes me to my final extension, which is triple trades. I've shown you that investors trade stocks and a sector ETF at the same time, and they also trade a sector ETF with the overall index at the same time. So what about trading all 3? Well, that only makes sense if your weight in the S&P 500 is large. Now, for a stock like Apple or Amazon, these stocks are big in their sector, and they're also big in the overall S&P 500. If you look at companies like American Tower Corporation or Linde, these are stocks which are large in their sector, materials or real estate sectors, but these are small sectors. So they're small in the S&P 500 overall. So what I should see is that stocks which are large in the S&P 500 will trade all 3. So Amazon or Apple, if there's a large stock-specific news, you can trade all three of these assets because your asset will explain returns in all three. But if you're large in your sector, you'd trade the stock and the ETF, sector ETF, but not the overall index. And I find just that. If we're looking at the simultaneous trade, previously the sector weight, which was so important in explaining whether people trade both the stock and the sector, is not important anymore. Now all that matters is your overall weight in the S&P 500. And now there's one final thing I want to talk about, which is I've shown that simultaneous trades are profitable and driven by stock-specific information. Well, we might be wondering, where do these profits go? Does it go into fundamental research about stocks, or does it go toward microwave towers? And the question is, from anonymous data, can we gain any insight? I'm going to show you that I can partially rule out that these trades are just latency arbitrage. And the way I'm going to do that is that latency trades should have a particular pattern. They should show up according to the geographic latencies between different market centers. So one form of latency would be a co-located high-frequency trading firm responding to a trade. So that would be the red path here within an exchange, and that takes about 20 to 30 microseconds. So if a trade takes place and an HFT firm wants to respond, that's how long it takes. You could also see a trade on one exchange and a firm responding to it on another. That would be the cross-exchange path here in blue, and that takes about 300 microseconds. So what I'm going to do is, here we have the same diagram of a timestamp of trade. And so, 10:32 a.m., now what I'm going to do is take the position of that simultaneous stock ETF trade, and I'm going to first check, plus or minus 20 to 30 microseconds, for a trade in the same data center. And then I'm going to check across data centers at 250 to 350 microseconds for a trade at cross data centers. And what I find is that these simultaneous trades don't seem to line up with latency arbitrage. So over this same data center entire interval, only 2% of simultaneous stock ETF trades have some sort of preceding event, which would maybe explain the simultaneous trade. And over the entire 250 to 350 microsecond interval, only 30% of simultaneous trades are preceded by a stock trade, and only 60% of simultaneous trades are preceded by an ETF trade. So these simultaneous trades don't seem to just be responding to other trade movements, but they seem to really be incorporating new information into prices. This is consistent with what we might have expected from Michael Lewis and the Flash Boys story, which is that traders use these strategies to avoid latency arbitrage. The technical sophistication needed to respond to a trade in minimal time is high, but the technical sophistication to place a simultaneous trade is much lower. And so that means our prior concerns about ETFs are going to be moderated. So if we're worried that the ETF is going to cream skim noise traders who only want the market portfolio, that's an idea dating back to Gorton Pinocchi 91. And that's going to potentially reduce the incentives to acquire stock-specific information, because these noise traders are going to leave single stocks and only trade the ETF. Tandem trading is going to limit these concerns about ETFs. If traders can access liquidity by trading both the stock and the ETF, they're going to maintain their incentives to acquire stock-specific information. But this idea only works for large volatile stocks. So to conclude, how do ETFs impact price discovery? I show first that traders in larger medium stocks can access ETF liquidity. Empirically, I present evidence that investors trade both assets in tandem. They place these same directions, simultaneous trades in the stock and ETF. These trades are driven by stock-specific information. These trades are profitable, earning negative realized spreads, and they're sizable, with these simultaneous trades making up a significant share of ETF trading volume. And that means the model shows that the effect of ETFs on these larger medium stocks is going to be limited. If the liquidity moves, informed traders follow it. Concerns are going to be localized to small stocks. Empirically, I don't see evidence of this tandem trading. And in the model, I show that investors with small stock information just aren't informed enough to be able to trade the ETF. So I conclude that ETFs have this asymmetric effect. They have limited impact on larger medium stocks, but they may be harming small stocks. And with that, I'll stop sharing my screen and turn it over to Albert.
Thanks very much, Tom. Just a reminder to everyone, if you have questions for Tom, please send them through the web chat, and I will relay them to Tom after the discussion. So for the discussion, I'm very pleased to introduce Albert Menkveld. Albert is a professor at VU in Amsterdam, and he's published microstructure, particularly known for on high-frequency trades. So over to you, price discovery in ETFs.
Okay, thanks a lot, Carol. You're frozen on my screen. I hope I'm not frozen on everybody else's screen, and that you can hear me. Okay, so everything's good. So this is a wonderful paper that I was delighted to read. So I'm happy that I was asked to discuss the paper. ETFs have been around for quite some time now, and boy, are these things liquid. Here's a picture of somebody who wants to work for ETFs, even be paid in ETFs, I guess. So here is my takeaway from the paper. And throughout the years, I'm typically walking around with the ideas that I laid out in the paper, and I'm asking myself, what is really the punchline of the paper? I mean, how does it contribute to what I know is the extant literature? And I forced myself to write it down in one sentence. And so this slide is going to be completely empty except for one sentence, which is the following. So the author argues, and it's important to mention that it's both theory as well as empirics. He argues that informed investors, they trade on stock-specific information in the stock as well as in an ETF holding that stock. So they have some stock-specific information, they're trading on it both in the stock and in the ETF, but only if the stock has a large enough and I call that volatility share in the ETF. Okay, so if you have some material information or some information about stock, only if the stock is large enough in the sense that it can move prices in the ETF, will an investor trade on that information ETF. So you can have a large volatility share in the ETF, either by being a large part of the ETF as a stock, or as you mentioned, PayPal is a small part, but that's not necessarily a problem if that's accompanied with PayPal information being huge. So a lot of volatility in the stocks. That's why I like to think of volatility shares as opposed to any other shares. So to me, that's the punchline of the paper, and I think it's well executed. But I'm not convinced yet that this is really going on in the real world. And here is a couple of thoughts that I want to give you to think about. So the first one is, and it's great to hear you go through the paper again after me reading it twice now. I can't, exclude the alternative story here, that it might not be only stock-specific information. You make it sound as if stock-specific information is essentially everything there is to trading in these stocks. I think that industry-specific information might be, you might tell the same story and then finally replace stock-specific by industry-specific information. I might be wrong, but I think everything works out the same way. So you get observational equivalence between these two stories. And here is roughly how it goes. If you know that the Trump administration just issued a ban on tech workers coming from China, that's going to affect all tech companies in major ways, and that's going to therefore change the value of all of those stocks, and for sure the technology ETF. And you want to trade on that information not only in the ETF, but you want to trade on that information also in the stock. Now, I can't. We're not like having a discussion here, unfortunately. But I can see you argue. But wait a minute. I've just shown you that on earnings days and on Ravenpack information days, I have a lot more tandem trading than outside of those days. Well, that in itself doesn't tell me that industry information is not a big part of it. It tells me that there's stock-specific information going on. But to me, the important thing, particularly if you think about real-world trading, is how much of it is industry and how much of it is stock-specific. And to play devil's advocate, if you have only a 15% increase on days where it's really Microsoft that should be in the news, then maybe 85% of all of that trading is industry specific information. Now, I don't want to, I'm not here to tear things down. Quite the opposite. I'm trying to help to refine the story, or to connect between the theory and the data, if you will. So one way I think you would convince me that it's really stock-specific information, that's all there is to it, is to show that whenever you have a news on a particular stock, or you have a tandem trade, let's say, in Microsoft and the technology ETF, why don't you show me what the permanent price impact is, conditional on that event happening in the next few microseconds or seconds or what have you, what's happening to Apple and PayPal. If there's no permanent price effect on these other stocks, then you've convinced me that it's 100% stock-specific information. If there is permanent price impact, which I assume there is for all the other stocks as well, because of the example I've just given, and many other examples one could come up with, then this at least gives you a measure of the extent to which it's sector information or company-specific information. I'm spending a lot of time on this first point, but deliberately, because I think it's my most important point. So the other thing I was immediately reminded of, and you cite that paper, but you don't spend a lot of time discussing it, is the paper that I saw Maureen O'Hara present, Huang, O'Hara, and Zhang. Well, they have a completely different story, which is something like if you have, if you're holding a bit of information on a particular stock in your hand, but any stock will also come in with exposure to the industry. What you really want to do then, if you don't want to take a position in the industry, is to buy the stock and short the industry ETF, and then you basically hedge the industry component, and you really long only on the idiosyncratic stock component. If I understood that paper well, that's their story, and it's an empirical paper. They've got lots of analysis to back it up. Now, your point is, well, but if I have that tandem trade, they move in the same direction rather than opposite. Yet, I think it's a duty on all of us to try and reconcile why your evidence is different from what they have. I'd be very interested to hear what you have to say about that. Then a bit more technical point, and maybe the Plato conference is not the right venue to debate this. That's why I made it point 3 out of 4 points. Is I'm not a theorist, but I like theory. I'm a big consumer of theory. Now, the way that the model is written down, if I understood it correctly, is that you narrow the strategy space in only mixing between pure strategies. So either you trade only in the ETF, or you trade only in the stock. And if you want to trade both, you basically, you flip a coin, and then you buy a coin, and you trade one or the other. Of course, when you read this, and I couldn't find it, what you can immediately think of, why do we want to have that construct? Maybe we want to have it because of tractable results, but the more natural one would be write down a model where an investor can trade both the stock and the ETF, and basically optimize that way. That's probably coming a lot closer to reality, but maybe that's not tractable. But I wanted to hear why it's not tractable. It doesn't sound like an awfully complicated model to write down if you only have 2 stocks in an ETF, but I might be wrong. And finally, and this is the bigger picture point, so the noise traders are rather sticky, at least in most of your model setups. So they stay in the habitats of either stock A or stock B or the ETF, and then you've got this informed trader considering what to do. But when you come back to where you started, which was the BIS quarterly concern, that okay, what is it? Why should we not be so concerned that nobody starts collecting stock-specific ETF? Then, yeah, I can see your story. You're saying, well, we don't need to be that concerned because you can still collect that information, at least for large stocks, trade it in a particular stock, but also go to the ETF and trade it there. So there's continued incentives to collect information, but that's on a big assumption. That's the assumption that the noise traders will stick around in the individual stock habitats. If there is another vehicle created where these noise traders can go, which is the ETF, then they might actually, if they start losing more, and in a way, if you have informed investors, a better world for them because they can trade on that information in the stock and in the ETF. They trade that information in the stock and in the ETF. They have extra incentives to collect information. So there's more information maybe in the market for stock A. That makes, market makers in a typical model don't lose anything. So they'll just quote wider spreads or charge larger price impacts. So the people that are paying are the noise traders. If they see they're actually losing more by sticking around in being noise trading only in habitats of stock A, they might actually at some point see their bottom line and conclude that it's not really a good world to stay in, and so they might actually switch over, either leave the market entirely or switch to trading ETF. I think that's at the core, at a deeper level, the concern of the BIS quarterly. Having said that, let me be clear. Science proceeds in small steps and careful steps, and this is certainly a substantial, a significant step forward. The way you wrote the paper, the way you developed the model, but I think these concerns might be worthy of thinking through. But again, I can recommend the paper. It's very carefully executed, very convincing empirical analysis. Most of my stuff is with the interpretation, I think. With that, let me hand back to Kavel. Thank you again for letting me discuss this paper.
Excellent. Thank you, Albert, for those very interesting insights and alternative explanations. Before giving Tom the opportunity to respond, we have a few questions from the audience, so I'll go to those first. And it'd be very interesting to hear from anyone in the audience who's trading ETFs that maybe has any alternative stories or explanations for what Tom's observing in the data. So please send through your questions or comments. So the first question we have is from PK Jain at University of Memphis, who has firstly a suggestion and then a question. So he says, it will be interesting to examine times when arbitrage does occur after price divergence. And then his question is, does ETF creation and redemption activity increase more after simultaneous trades or arbitrage trades? Okay. So you can go ahead and answer these questions as we go, sure. Tom.
Great. Those are good questions. So one, arbitrage trades are definitely something I want to look at in the future. One of the problems with arbitrage, there are a lot more technical challenges to address. So you start running into issues like clock drift. The other big problem with arbitrage is instead of measuring a simultaneous trade, you're looking for a trade followed, some latency later by a following, trade that's responding. That's some sort of latency arbitrage. And the issue there is exactly how long that response takes is endogenous to trading volume. So when there's a lot of trading volume, it can actually take longer to respond to a trade. And when there's less trading volume, that response can happen quicker to the point where you can start getting overlapping intervals of how quickly these responses are happening. And so for future work, I think that would be a really fascinating thing to look at. For this paper, what I wanted to do was just focus on the simultaneous trades because that has the advantage that 20 microseconds is a nice clean bound. No matter what, if I see two trades that are less than 20 microseconds apart, I know they aren't responding to each other. So now to the second point about creation and redemption. I haven't looked at creation and redemption so far. My entire point in this paper, I'm just taking the view that creation and redemption happens, and so there's never a deviation in ETF value between the ETF and the underlying. But it would be interesting to see if some of these creation and redemptions are tied to arbitrage activity. It's a little bit tough because there are a lot of other things that can cause a lot of ETF creation redemptions. There are tax reasons, and that'll really dwarf any other variation. Maybe one point worth mentioning is I don't think people, when they take these simultaneous trades, I don't think they stay in the ETF side of the trade for very long. The Sharpe ratio will decline pretty quickly. So over 30 seconds or 5 minutes, it makes a lot of sense to trade both. Over a few days, it doesn't make sense to hold the ETF based on a single stock. And certainly not on a few months.
Great, thanks. So Barbara Rindy has a clarifying question that might be helpful for others as well. She says you have microsecond data, but trading may take place at higher frequency. maybe nanoseconds. So you could have clustering of the data at the microsecond level because the data is not recorded at a high frequency. In other words, the data you see recorded at the same microsecond may or may not be simultaneous if you could check them recorded at the nanosecond level.
That's a great question. So trades are timestamped to the microsecond. And this question matters a lot, kind of for the previous concern about arbitrage trades, of kind of who gets there first if there's a race between two firms. What's nice about simultaneous trades is that it doesn't have to be so accurate that I just need to see trades that happen at the same time. They don't have to, I don't have to say, which trade arrived first. I just have to say these trades happen so close in time that one's not responding to each other. Now, I should talk a little bit about trade patterns here too, which this question raises. So at the millisecond level, there are clear patterns in when trades arrive. At the microsecond level, if you look at the distribution, it's totally flat. It's a nice uniform distribution. And the final point is that with the exchange computer systems operating, there's never going to be able, once you get down to the microseconds, there's always going to be some jitter in when trades are actually processed by the computer. That process starts taking, a microsecond or two. And so I'm not sure about the returns to going to finer time horizons. Because really at that point, you're just measuring sort of jitter within the computer system.
Okay, great. Thank you. We have a question from Hamza, who I'm afraid I won't get your last name right. Hamza Bahajwaj from Peckham. He asks, can you use this model to exploit long-term opportunities?
So I think in the following sense, which is if you think about a long-term event, at some point the price has to move between now and then. And you could think about really that price has to move in a series of discrete small movements. So one case in which a long-term trader might want to use this strategy is, suppose you have long-term information of a stock and you want to take a big position in that stock. And what you're going to do is you might worry about your price impact. You're going to drive up the price of that stock. Well, that means you're also in the short run going to drive up the price of the ETF. And so you could place a tandem trade in the stock and the ETF. And then once you've acquired a position in the stock, you can sell off the ETF portion and hold that stock long-term. And you can kind of capture some of your own price impact from trading, by trading the ETF.
Okay, great. So a question or perhaps a comment from Carol Gress. I'm very convinced by the finding that there is less or no tandem trading in the small stocks. However, it may be underestimated because simultaneous trading does not mean the same when trading in a stock that's less frequent. So by taking a window of a few microseconds, you may miss some tandem trading for small stocks just because it takes more time.
Okay, that's a great thing to consider. I will say one case where it doesn't seem to show up for small stocks is actually, I didn't cover it today, but in the paper I have a placebo test where I look at an equal weighted sector spider. And so it's exactly the same as, say, the technology sector in terms of the stocks it holds, but Microsoft has given an equal weight with a stock like PayPal and Xerox. And what I show there is that I don't see any of this pattern of simultaneous trading for a stock like Microsoft. And so it's a perfect null result, that it's not something maybe specific to Microsoft stock that it happens so simultaneously. In an equal weighted ETF, I don't see any evidence that traders trade Microsoft in an equal weighted technology sector ETF.
Excellent, thank you. So keep the questions coming, but we have we've answered all the questions so far. So perhaps let's give you, Tom, an opportunity to respond to Albert's observations.
Sure, and so they're very clearly organized. So let me start with the first point, which is, could this be to do, is this stock-specific information or industry-specific information? And I'll start with the empirical point that there's really no such thing as stock-specific information, right? Empirically, any information that we think is really specific to a stock can't help but affect that stock's competitors. So even if something was really only about Apple, of course it's going to affect Apple's competitors. But what I want to say is, if we think about this continuum between the theoretical purely stock-specific information and the theoretically purely factor-specific information, we're going to lie somewhere along this, information can all be placed somewhere along this line. And I want to make the point that when information is closer on the stock-specific side, we see this tandem stock ETF trading behavior specific to that stock. So when news comes out about Exxon, of course, it's going to affect the competitors. Where I see the largest increase in simultaneous trading is between Exxon and the ETF. And if I look, for example, in the oil sector, Exxon and Chevron are both about the same size, both about 20% of the ETF. And what I see is that there's a big spike when Exxon stories come out. The spike is bigger between Exxon and the ETF compared to Chevron. And the opposite is true when Chevron specific stories come out. The spike is bigger in Chevron and the ETF relative to Exxon and the ETF. And so it's true that no information is purely stock specific, but I want to make the point that here when information is closer on one side than the other, I see this stock specific spike in trading. So the second point I want to discuss is the paper by Huanghua and Zhang, 2018. They show that investors can use industry ETFs for hedging. If you take a long position of stock, you're taking on a lot of industry risk, and you can hedge that with an ETF. My paper does not in any way mean that this hedging doesn't occur. I just mean that when you see a simultaneous trade, those simultaneous trades aren't hedging. And the reconciliation here is if you want to place this hedging trade, there's no reason to do it simultaneously. In fact, it would be optimal to wait. If you want to buy ExxonMobil, that might possibly push the ETF price up. And so you should wait a few microseconds to actually take the opposing short side in the ETF. So that's the reconciliation there, which is simultaneous trades are definitely not hedging. The hedging would actually make sense to not do hedging trades simultaneously. Then there's the two empirical theoretical questions. So the first question is, why mix these pure strategies? So what really makes the ETF such an intractable theoretical problem is that the ETF is perfectly collinear with the underlying assets. So if you take stock A and stock B, add them together and make that ETF, what's really hard to get is a model that explains how the ETF has separate volume and a slightly separate price. And so in a linear model, you just can't do this. And what's normally done is to assume that the stock and ETF are just separate markets and there's no communication, different traders. So what I want to show that people trade both at once. And I find that a really easy assumption here to make that work is to assume that traders mix pure strategies rather than using sort of a trade both directly strategy. And what's also nice about that assumption is that it also brings with it this fact that it's a built-in risk limit on how much investors can trade. And so when you think about mixing a pure strategy of trading one or the other, you're always holding constant the total amount they're trading. So you're holding constant, say, the total amount of industry risk that they're taking. And so then finally to the fourth point on endogenizing noise trading. In the model, the stock-specific noise traders are in the stock, and that's that. They need to trade the single stock, and so they can't move around. The noise traders who can really move around and they have the flexibility to move around are the ETF traders. Those are traders who have some sort of market-based shock. What I analyzed is actually in the absence of the ETF, they would have to trade individual securities. Once the ETF is added, they all trade the ETF, always. And the reason I can be so sure in that, and I don't have to consider cases where they're changing specifically how they trade, is that the ETF quote is always dominated, in a sense, by the individual stock quotes in terms of the trading flexibility it gives you. If you want to trade a portfolio, let's say whatever that portfolio is, you can do it using the individual stock quotes. If you want a portfolio that's 100% stock A, you can use the individual quotes to do that. If you want 70% A, 30% B, you can use the individual quotes to do that. If you want the market portfolio, you can use individual quotes to do that. You can only use the ETF quote for one and one thing only, which is to get the market portfolio. And that's how in all equilibria, the ETF quote can be no worse than the individual stock quotes. Because if it was worse, no one would trade the ETF. They would just get the market portfolio from the individual quotes. And so that means since the ETF portfolio quote can never be any worse, the noise traders who want to trade the market portfolio will always use the ETF to trade the market portfolio. There are some rare exceptions to this in practice. That's going to happen in really small ETFs. And for that, we'd want to model with some sort of trading frictions, which would be quite different from the model I have. Okay.
Terrific. Thank you, Tom. We don't have any further questions at this point, so we'll just give everyone a moment in case there's any last-minute questions. But while we're waiting on that, for anyone that didn't join us this morning, the way the conference is set up is there's a separate room essentially for each presentation. So once we wrap up here, I'll drop out and we'll rejoin you again when we restart at 2 p.m. London time. But you can continue to stay in the room that you're in, and the next session will be live streamed to that room. So we don't have any more questions. So with that, I will thank Tom very much for the presentation and also thank Albert for his insightful Cool discussion. And thank you to the audience for their questions. And we'll take a short break and see you again in about 10 minutes.